to introduce you to another webinar, this time on loan notes, under the title "How Lending Can Be an Attractive Investment, Can Be an Investment with Attractive Yields." So the webinar is obviously hosted by Santiago Investment Advisors, but Graham, who is Managing Director of our associate company, Santiago Capital, is giving the presentation, and Graham will go through the loan note market, how it is, why it exists, what the recent developments are, what the role of Santiago Capital is in the loan note market, and then he'll focus in on a particular loan note issue or loan note offering that Santiago Capital has. Now, just to be kind of for clarification, so in this presentation, Graham is speaking as in his capacity as Santiago Capital. The suitability or appropriateness of a loan note will obviously be, if it goes into a pension scheme or on a personal account, is obviously done through Santiago Investment Advisors. But we can address that later. So with that, I'm delighted to say hello to Graham, and I'm also delighted to say that some of you will be familiar with our backdrop here. This is our NACE office, and Graham is operating from our new office on 19 Grattan Street, which we moved into only in the last 2 or 3 weeks. So we're delighted with that. It's a wonderful new building just with Santiago Capital and Santiago Investment Advisors, and we do hope that when we get back to some degree of normality that many of you will come and visit us in our new office. So Graham, looking forward to the presentation.
Thank you. Thanks, Ronan. And just to add my welcome to Ronan's to everybody, you're all very welcome indeed. I'm here in 19 Grattan Street, not Grafton Street, just in case somebody misheard that. And very comfortable and stylish I am too. Well, the office is at least. So without further delay, I'm just going to switch into a presentation just to go through the nuts and bolts of loan notes definition. What is it? What are we talking about? So I'm just going to drive this Zoom screen, and hopefully I won't lose you all. So if I've done that correctly, Ronan, you should be able to see the first slide. No, not yet.
Yes, just coming up there now, Graham. Graham has started sharing his screen. And yes, I can see our website, Santiago Investment Advisors website.
Okay, so that's slide one. And you all know me from Santiago Investment Advisors, which is a big part of my career and a big part of what I worry about. But I also have other responsibilities in Santiago Capital. And indeed, I lean on Ronan and Nena a lot for Santiago Investment Advisors duties. So that's our website. I don't know how many of you might have been in it before, but now I'm going to change my hat and talk to you as Santiago Capital, a dedicated Irish alternative lender. That building is probably our most photogenic. It's at the airport. We provided bridging finance for the construction of it. The particular promoter in that instance was selling his business, and just there was a liquidity problem. So Santiago Capital we're very pleased to step in, and isn't it photogenic? And hopefully we'll all be able to go to the airport soon and go on holidays and wave at it as we go by. So loan note, some of you may have heard of loan notes, some of you may not. What do we mean by loan notes? And as far as I'm concerned, the best description of the distinction between what makes a loan and what makes a loan note is that a loan note is issued by the borrower, like a bond. So a pension fund cannot make a loan, but it can invest in a bond. And so loan notes, particularly in the absence of the mainstream banks, have become quite a popular way of financing things, and it suits investors and it suits borrowers. And certainly there's a gap in the market there. After that, all the terms of a loan and all the terms of a loan note, they can match each other pound for pound. The terms can be bespoke. You can take charge over a property. It can be supported by make-weight security. There can be a guarantor. Security, if it's written correctly, can be enforced through the legal system. And there's all sorts of variations. And I've seen loan notes that run to almost 100 pages. And I haven't done any myself, but the loan note technically could be fit on a post-it if you wanted to be scant about it, but I'm not advocating that. So really the difference is it makes loans investable, a technical way of investing in loans, and pensions subject to the approval of the trustees, which in most instances for our clients would be by ITC, are a valid asset class. So after that, what are you going to, how are you going to judge a good loan note from a bad loan note? And I think it's the same thing that you would use to judge a good loan from a bad loan. Who is the borrower? In every instance, we check into the background of the borrower. What's their track record? Have they executed on transactions before? Have they a bad reputation? Are their bona fides reliable? And there's plenty that don't make the grade. What's the loan for? It could be for a very worthwhile, intuitively appealing idea, or it could be for something that sounds very high risk and has a high chance of failure. So you can quickly see that the loan note is only as good as the way that the loan note is written and the underlying security. The value and quality of the collateral are hugely important to Santiago Capital. Good marketable title. So, does the borrower actually own the asset? Have they the right to give us it as collateral? Is there any issues with the title? There can be, and we do come across them, and we occasionally have to get things remedied, or maybe it could be a deal breaker. Perfected security. This is probably, well, they're all important ingredients, but this one is very important, that you actually have the security that you think you have, that if the thing goes wrong, and sometimes things do go wrong, that you are able to enforce. And with that in mind, we have our own in-house lawyer in Santiago Capital who recruited in the middle of COVID, actually. But at that stage, we might have written 30 or so loans, which Jenny was able to review and pick out the bits that were most important to us, and come up with a kind of a bespoke Santiago Capital gold standard loan. And then what is the exit? When you're lending money out, you really need to be thinking about how are you going to get it back? What's the plan here? And in Santiago Capital, I think about giving the money out with my right hand, and then I nearly have my left hand out ready to get it back. And we'd like to see that circle back to us. We are not really in the business of terming out loans. We like short-term loans with a clear exit. And very often that exit might be that the site is going through a planning enhancement, or the site is going through some kind of asset management enhancement where there will be a refinance. And it's more often through the other alternative lenders like Realm and Finance Ireland, as opposed to the mainstream banks. But also very oftentimes it ends in a sale, particularly where it's a social housing play, which is a major feature at the moment, not one I particularly envisaged when I got into the lending business, but there's a huge amount of capital being made available through housing bodies and through local authorities for social housing. So keeping going, so again, the lending criteria, we need to make sure that all of these criteria are to the highest standards. We do that through thorough due diligence, through robust legal documentation, a reliable valuation. In this instance, if somebody wants to invest in this loan note, the valuation will be for the purpose of the loan note, and the valuation firm will be accountable to the loan note holders. Judgment does come into it, just sniffing out a bad one, or maybe, you know what, you just as soon not do this loan and wait for the next one. And there's plenty that we don't do. And you know, maybe there's nothing drastically wrong with it. We just, because there's such demand, we have an ability to take our pick. The experience that we have in our team, we have a certified chartered accountant, we have a professional lawyer, we have an experienced credit committee, and we have, we're constantly refining and thinking about what we do and trying to make it safer and more secure and work more smoothly. So that's, some of you might have had a look through our brochure, which I sent around yesterday. That's just an excerpt from it. And we're trying to set standards that capture all of the risks, and that by the time the loan becomes a loan note, it's a nice fillet that investors can feel comfortable with. So we won't dwell on that. What are the risks? And there most certainly are risks. One is that the loan is not what it professes to be, and I'm sure that the courts are littered with disappointed plaintiffs that thought they had good perfected security but didn't. We take the greatest of care to make sure that we have security. And in the case of this loan note, for anybody that does invest in it, we are appointing a third-party solicitor, and the designate is Hayes Solicitors, which is a fairly big firm. It's not one of the biggest firms, but it's certainly a well-known firm in Dublin with plenty of partners and plenty of indemnity insurance. And the job of Hayes is to review all of the underlying loan documentation, to review the title, to review the agreement between Santiago Capital and the loan note investors, that you don't have to take my word for it or Ronan's word for what it is you're getting. Hayes will tell you what you're getting. And when I envisaged or thought about how do I get some of this good stuff, because it is quite rewarding lending, how do I get some of my good clients into this as investors? I didn't want them to be relying on my understanding of it. I wanted a third-party person who is qualified to opine on what exactly they're getting. So I think we should just take that as given for the purposes of this presentation, that it will be robust, and any questions you have on its robustness from a legal point of view will be dealt with by the professionals who work for the investors, not for Santiago Capital. And then the other risk, of course, is default. And if your loan does default, well, then it's so important that the previous things that we looked at stand up, that you have good marketable title, that you have perfected security, that the purpose was a worthy purpose, and that while the loan might be, and default could mean that a coupon payment is missed or that a loan is not redeemed on time, it doesn't necessarily mean that it's turned into a disaster. And I would say that, you know, the risk with these loans, what we're offering investors is at a 50% loan to value. The borrowers we have experience with in most cases, and that they are reliable stand-up people, but even the most reliable stand-up borrowers, sometimes just in the property game, some sale might not come through as quick as they thought, or they might not get a planning first time round. So there is a propensity to miss coupons. We have so far sold down 2 loans and the coupons have been paid. You could set your watch by them. So I'm not advocating putting your money into something that I think might be shabby, but I think that the risk of a coupon being missed is not negligible, but the risk of actually not ultimately getting all your capital back and all the coupons due, that there's capacity in the valuations to recover all of that. So that's just a little bit more about the structure. Santiago Capital write loans all the time. We get redemptions all the time. I have, you know, put a square around half a dozen of our loans that meet certain criteria. So the criteria for this really is that they pay their coupons, and that we can do it at a 50% loan to value. And you can see that the way I explain it, Hayes can give their own explanation, as the investors hold the loan note. The loan note is secured by a carve out of Santiago Capital's loan book, and the loans each in turn, you know, are stand-up loans with security and obligations and protections built into the underlying loan documentation, which is something that the solicitors will review. But all of this is completely available to any investor to review themselves if you've got the energy. But anyway, I think we can rely on Hayes to call it as it is. So that's just overlaying the slide with the role of Hayes solicitors to check all the underlying loan documentation, inspect the title, and advise investors of any concerns they may have. So these have not been pre-checked by Hayes. This is the first check Hayes will do. We've done our check. Some little peculiarities or rinky-dinks often go with the title, and you need to just get the opinion from the lawyers. If anything untoward turned up in Hayes' review, I would just drop that loan from the sell down. I wouldn't try and force a loan in where it wasn't pristine. Hayes will draw up the loan agreement between Santiago Capital and the investors, and they'll advise the investors on all of their rights and dues. So while Ronan, you know, can think about the asset class, is it good or is it bad, and who's suitable and who's not suitable, we're taking it as a given that the loan note is what it professes to be. And in case you don't believe that, we've got a third-party solicitor to vouch for it and undertake a proper job of work going through each loan top to bottom. So why are loan notes an attractive asset class? I think, clearly, if you thought you would get your 7% every time and you thought you'd get your capital back every time, you would take a mortgage out at 2% and invest in loan notes at 7%, and you'd have a nice arbitrage going there. The fact is that the Irish banks have pulled their horns in massively, and maybe their horns went too far out, probably they did. But I was just looking over some numbers there. In 2007, between them, Bank of Ireland and AIB had 50 billion in real estate, commercial real estate loans, 50 billion. They now have 16 billion. Anglo-Irish Bank had 96 billion in loans when they went under, and they're gone now. So that's 96 billion plus the difference between 50 and 16 that is just not in the market at the moment. Now we know that ended terribly badly, and I'm not saying we should get to those levels again. But in the aftermath, while liquidity was pumped into banks through quantitative easing and supports, government bailouts, the taps didn't really turn on the other end. So the banks kind of have swollen up with capital, but they haven't really been lending it out. They're very happy to do mortgages, but they're very cagey about doing much else. And that's down to preserving their core equity ratios and very tough accounting standards. And the way I look at it is the bank can lend into mortgages all day long, and the provisions might be for every 100 grand, you have to make a provision of 1,000. I'm making these numbers up, but just to illustrate the point. Whereas if you're lending the type of stuff we're doing, the provision might be a multiple of that, a large multiple of that. And then, okay, we're looking at the window at COVID and empty offices, and I see Google have pulled out of a purchase there in Grand Canal of an office they were going to buy. It is a bit of a worry, COVID, and how it will affect workers, and will towns be the same. Personally, my view is that we do get back to normal over the next 18 months or so. And well, doctors differ, patients die, you can get your own opinion on that. But one thing that I will point to is the negative yields. So if you think about, if you have your pension fund in cash, if you go back half a dozen years, you could probably pick up 2 or 3% on deposit. Now you're picking up minus 80 bips, 60 bips, depending on which bank it's with. So the money is literally burning a hole in the pension, and the psychology of valuing the yield on a property and how much you pay for it, the first thing you look at is kind of what's the risk-free rate, and the risk-free rate is now negative. And then there's enormous, which Ronan and I have spoken about before, stimulus, monetary stimulus and fiscal stimulus to support economies and keep GDP growth going. So in that against that backdrop, I think that, particularly for social housing sites, that valuations hold up. In any case, we have a 50% buffer, and we're recommending a portfolio approach. So we're not recommending anybody wade into these loan notes up to their neck, but that we think that in a portfolio they can play a role. So that brings me on to the actual loan note itself, and I have 2 slides on this. Okay, one just lists the assets that we're going to go into it, and the other is just the headline. And I've said indicative heads of terms. I say indicative because lending is like shifting sands. You might find that you're about to make a loan, and then the borrower, for some reason, changes his mind, or he gets financed elsewhere, or you might have made a loan and you expect for it to be out for a year, and then a few months later that you get paid back because the promoters had an offer on the site and he decides to sell it. So it's quite fluid, and the principles are going to be the same, but the actual candidates that go into the loan note might change. But we're not going to try and rush anything in. Anything that gets into the loan note will be reviewed with all the care that I've just described. The interest is 0.5% per month and 1% on redemption. I expect most of the loans to last less than a year. And I envisage that there will be 6. The maximum loan to value will be 50%, and the 6 that I had selected, the average was 45%. Santiago Capital don't underwrite the loan, but they give the security, all the security we have, you get. But if it doesn't work out, well, then that's we're not going to pick up the tab for that. And the maximum term on any of the loans going in is 24 months. I don't think it'll run that long, but there's scope for it to. I'd expect that 80% would be redeemed within the first year. And at that stage, we will say to investors, well, look, that one's redeemed. We have another one that we've written. It looks quite similar. Would you like to replace the capital or rotate the capital back in? But that's a conversation for down the road. And in every loan, Santiago Capital will leave a 10% minimum of its own capital with our feet closest to the fire. So until investors get paid all their interest and all their capital, Santiago Capital don't get any of their money back. And that's something that the lawyers can vouch for as well, because it'll be documented. I did mention that, you know, probably the risk of something happening, the most likely thing I see happening is that a coupon might not be paid on time on one of the loans. And where that happens, the rate of return on the loan ticks up by 1/4% a month for the investors. But it may be that you don't get that catch-up payment until the loan is finally redeemed. So that's just to compensate people for the extra weight. And what I'll do now is I'll just go into the actual loans themselves. And I'm sorry if I'm going a bit quick here, but I just want to...
Graham, if I may just say something, if any, I meant to say this at the start, so apologies. If anybody has any questions, please use the question. You're all quite familiar with this, I suspect, in terms of doing Zoom and webinars. Use the question and answer button at the bottom, and there will be plenty of time once Graham finishes to ask questions. So if anybody has any questions, just please use that Q&A button at the bottom.
So that was the technical piece, really explaining well, the heads of terms and how the loan note structure works. Now we're actually going to do something that's probably much more interesting. We're going to zoom around on Google Maps and look at some of the sites that we're proposing to put in the loan. Before I do that, though, the second loan mentioned there, Cove, the promoter in Cove looks like he's going to redeem his loan. He's been offered 3.75 million for the site. The site, he initially had an offer of 2.2 million for half the site, which was 69 dwellings, of which 45 to 50 were going to end up as social housing. And he was going to get the planning on the second phase and then sell the lot together. But he's had an offer from, well, I won't disclose who the offer's from, but it's a very credible operator. So that's one, and that really illustrates the point that they are quite fluid, and that the people who borrow the capital at these rates, they don't want to have it out forever and a day. They want to get their planning or whatever it is they're going to do and then get refinanced or sold. So that means that loan, Cove, I'll find another candidate for it, and I'm not going to slow the thing down. But there was a second loan that went with it, which is the bottom loan in Cork City. So I'm going to now talk about Leixlip, Cabra, Inchicore, and Cork City. Okay, and I'm going to start with Leixlip. This is a very simple. This is a very simple loan. So I'm just going to stop the share for a sec, and I'll reshare then when I've got onto Google Maps. Now this is the bit where I get a bit panicky. What's this now? Okay. Now.
Very good.
Okay, so that's the Irish Times we're looking at now. That was just an article I was looking at. So I just, are we looking at Google Maps, Ronan? I can't hear you. I can't hear you.
Sorry, Graham, start off with Leixlip. We were just down in Cork, so start off in Leixlip, and
so we'll go to Cork, to Leixlip. Leixlip is just on the Kildare Dublin border, North Kildare, most famous for well, it used to be most famous for traffic, for Dublin people trying to go on their holidays to Galway. A friend of mine once ended up staying in Leixlip because they'd been in the car for 3 hours. And the kids were going, "Are we there yet? Are we there yet?" But we're just following out the main artery, the N4, which becomes the M4 out west, and we can see Leixlip, and famous for Intel these days rather than traffic, and a fairly vibrant town. And slap bang in the middle of Leixlip is the site. So this site was bought for 4 million, and the developer had plans to put 33 houses on it. The planning was actually refused. The zoning is perfect on this site, but the planning was refused over density, so he's going to resubmit. And I think it's somewhere around the 45 mark. I haven't seen the final plans yet. 45 units. It's a common thing now that the councils want to put houses where there's amenities. So you can see here, there's 2 schools and the GAA club. And the field, I understand it was an executor sale, and that's why it never got developed. There was many bids for the site over the years. The promoter was involved in the development of this estate here, which is called Cawley. And not only have we collateral over this field, we also have collateral over 2 houses in Leixlip, which are fairly, not exceptional houses, probably from around 1990 they were built. They're rented. So overall, at the time of the last valuation, our package of security was worth 4.8, 4.9 million. We will get a brand new red book. Sherry Fitzgerald did the original valuation, so we'll get a new valuation. Probably it will hold up. Anecdotally, I'm hearing that houses are selling very well, particularly outside Dublin. And maybe that's to do with COVID, that people think, well, if I'm going to be locked down, I want somewhere comfortable. And if I've only got to town 2 or 3 days a week, maybe I'm happy to commute. So
how much is Santiago Capital lent out here, Graham?
2 million.
2 million. Okay, yeah. Okay.
So we've 2 million out. He does pay his coupon. Once or twice he was slow, but he always made it up, and that was just through the ebbs and flows of the business that he's in. But if he stopped paying his coupon or if something happened to him, I feel that site would hold up very well, and it's up to our lawyers to tell us we have good security over it. So that's the first one that I want to talk about. The second one I want to talk about, we're going to go to Dublin, and we're going to go to Cabra, to Fassa Avenue. So Cabra is just between the Phoenix Park and the Botanic Gardens. So it's a kind of a gritty old part of Dublin, and our site is here beside the GAA club, and formerly it was a public house, Mats of Cabra. This is the site here, good road frontage, and stretches back. The site has planning for student accommodation, and the promoters, when they got their planning, they just felt they'd left a lot behind by not going for housing. And since then, the market for social housing, sorry, that was me, that was bad driving, just get back up here. Since then, the market for social housing has really heated up, and that what we're seeing is the housing agencies like Clúid, Respond, Focus, TUA, Father McVery Trust, these are all non-for-profit housing agencies that get funded through local councils and through central government, are acquiring sites. They're acquiring the finished houses, and usually they have a long-term lease from the local county council, but there's different models. But one of the things that is clear is that they will agree to buy all of the units on the site. Well, I'm not saying they definitely will in this case, but I've seen it happen many times now, that the housing authority will agree to buy the finished estate, and they do that liaising with the local authority to say, look, how many social houses are needed? And Cabra, many thousands, right? Well, we have a couple of hundred appearing here. Will you take them? And in actual fact, oftentimes the housing agency will buy the site and then pay the builder to build it. So they actually, that's the takeout. The takeout is that the housing agency will buy it. And there's a huge amount of funding. Part of that funding comes from the HFA, and the HFA, just I checked the statistics, Housing Finance Agency, I think it stands for. So last year, the Housing Finance Agency invested 745 million, primarily through housing bodies. And of that 745 million, 350 million came from Europe. So if you think about governments wanting to spend to stimulate economic growth, And then if you think about the political situation in Ireland, where by the skin of their teeth, kind of Fianna Fáil and Fine Gael hung onto their seats. They were busy going on about Brexit in the last election, whereas housing was really what was on people's minds. So the current coalition are going to stop at nothing, I think, to try and address the housing deficit, which runs at about 68,000 at the moment. And we are seeing that bubbling up in sites that, you know, you would turn your nose up at as somewhere to visit, let alone as an investment, but it actually underpins the valuations in a lot of our projects. So that's quite the phenomenon, and one that I could talk about for a while, but I won't. So I'm just going to zoom back out again, and we have a site in Inchicore. So Inchicore is, the way I get to Inchicore on Google Maps is I follow the canal. So there's the Royal Canal there, and
Grand Canal, Graham.
Grand Canal, sorry, the Grand Canal. So the Grand Canal, and people from your part of the world, Naas, would know the Naas Road and coming up through Bluebell into the city of Dublin. And our site is here on Jamestown Road. There's the Lewis stop, which is actually 400 paces because I pasted out myself to the site. So the site is Jamestown Studios and Jamestown's Market, and it has been rezoned residential. Formerly it was zoned industrial. And if you drop this little fella down here, you can see, you know, it was kind of old-fashioned Dublin City Council type houses, and the scheme is going in up here. And this is in the fast track planning process at the moment, or the strategic housing development process, where all of the interested parties, the roads, the water, the planning authority, the council, all get to contribute to what would be a good use or a bad use of the site. And the omens look very good for this one, that they want the densities up. And the promoter in this instance is an international promoter. They've done sites in New York, Romania, and Poland, and their work is fantastic. So Santiago Capital have agreed to finance this one through to the end of the planning process. They pay their coupons. They're good guys that we're very happy to recommend. So you can see again that one, that's underpinned by the whole social housing theme, which is a major theme at the moment. And it's great to have themes like that at times like this. Now, the last one I'm going to show you is in Cork. I have to go back to Cork. It is a city site. It's the old courthouse in Cork on the banks of the Lee. And the promoter is JMK Group. So he has half a dozen hotels, including, I don't know if anybody's been out to the Bewley's Hotel at the airport recently, but there's an enormous new structure has appeared there. It's a Holiday Inn. So that's part of this group of hotels. It's not open yet. It'll be open in the new year. He also has a new hotel going in at the old motor tax office in Smithfield, and he has a hotel, Holiday Inn, on O'Connell Street. You might know it there, squeezed in behind the Gresham. So this hotel now, you probably wouldn't want to buy a hotel today, given the fact that they're all closed. This hotel probably, you know, they won't turn a sod on it for another couple of years. The site has lots of other utility. My main concern is the site, and it could be used for housing. It formerly had planning for 65,000 square foot office block. Now let me just see, can I find it here? Now, key Camden. Well, I think this is it here. So just let me drop. Let's see. Actually, I'm going to cheat. Camden. Oh yeah. Okay. Now, there we are. So I'll just drop our guide down here, and we'll look across the river at the site. So that's the site there. That's the old courthouse, and it's quite extensive, the site. It's cleared now. So, and I just wanted to show you one other thing relating to this site, which is a picture from the valuation, just an artist's impression of what the office block would have looked like. But before I do that, let me just finish talking about it for a moment. With this site, the site was bought during COVID for 4.5 million, and the agents on it were Cushman Wakefield. The acquirer, Kajani is the name of the owner of the group. He put up an extra make-weight security of 2 houses in the Victorian Quarter, 31 and 32 South Terrace, which I'll just show you. This is the last thing I'm going to show you as well, okay? Just because I know it's a bit tedious watching me fumble around. Am I still in Cork? Am I going to South Terrace somewhere else? Here we go. I think we're... Okay, never mind. I'm going to forget that because I'm just going to distract people from the presentation. But suffice to say, it's 2 Georgian buildings that are put up as make-weight security. The valuation on the main asset came in at 4.5 million, which is what the hotel group paid for it. And the valuation on the make-weight, which he already owned and has no debt attached to it, is 1.3 million. In fact, it's 1.25 million. The ERV, or the passing rent of the thing, was rented fully on the make-weight as 118,000, and they valued it at an 8% yield. And any investor will be privy to all of that documentation and be able to check out those values for themselves. I don't think this is the forum to get into too much detail. So with that, I'm just going to go back to the presentation, which I'm nearly finished with, and thanks for listening, everybody, so far. Now.
Again, if anybody's any questions, we have a couple of questions that have actually appeared up on the chat box. But if anybody's any questions, if you could put them into the Q&A, and when Graham finishes, we'll just go through those. And I have a couple myself, Graham, if that's okay.
Yes, okay. Well, look, I don't think I've shown you the full screen there. My driving is terrible on this. Are you looking at the suitability slide now?
We are, yes.
Well, you're not meant to be able to see all that stuff. That's just the rest of the presentation. I'll shrink that. But so just on suitability, hopefully you got a good feel for what the risks are here and what the security is and how it works. And you can see that Sherry Fitzgerald or TWM or some reputable firm in every instance has valued the site. We've taken good security over each site. We've checked out the borrowers. We've done our due diligence. You know, the world isn't perfect. There can be a few bumps on the way. The two other loan notes we sold down, as I said, you could set your watch by the coupons coming in. I think these are good ones, but I'd have to say, if you jump a mile high, if a coupon was late, this is not for you. But if you understand that the underlying collateral is there and that the chances are all the payments will be caught up with, and that you might be working on waiting for a planning grant, or you might be waiting for a sale to come through. And you share my view that the housing market is underpinned because there's such a big shortage, and social housing is filling that gap and it's creating activity. And then with the negative interest rates, the yield looks all the more attractive, but it maybe also supports the underlying asset. So in the round, I think that they're a worthy investment. You are relying on Santiago Capital to do a good job, and you're relying on Hayes to make sure that we are doing all we say we're doing. So that concludes my presentation, and thanks again for listening, and excuse my bad driving on the satellite there, but if anybody wants to circle back for a proper look, when I'm under less pressure, I'll probably cope better. We're going live with this, and we do have some investors lined up just who maybe we're familiar with what we're up to, and we'll be taking their capital in. And we'd be delighted to add more to that, and we'll take great care of it. So, Ronan, just any questions?
Okay, so thank you, Graham. That was, excuse me, very helpful and very informative. Used to say, we have some investors who are very familiar with loan notes, and we have other investors or other clients rather who are less so. So that was very. There's a couple of questions coming in and a couple of comments. There's one I'll just get an easy one out of the way. First of all, is it possible for an investor to exit the loan note before maturity? So that question, or a variation of that question, has come in on a number of occasions.
It's entirely possible. And let's say, for example, the reason for wanting their capital back was just to do with that particular client. It wasn't something to do with the loan note itself. Probably we would let them have their capital back. We wouldn't be legally obliged to, but we've got loans coming back and loans going out, and we're generally liquid, or we could find someone who'd take on that slice of the loan note. But if it was a situation where a bit of bad news broke out about one of the sites and someone wanted to get out quick, I wouldn't bank on it. I think really you're going in with a view to staying in, I'm not going to sell on the basis that it's easy to get.
There was a follow-up to that said, and what kind of exit fees apply for the investors? Okay, so I think you might just answer that, Graham, in the context that this is not a fund, so there are no entry or exit fees, which is a little bit of a hallmark of some other loan notes. Okay, people are taking a slice of the whole lot, but it's not a fund, and therefore there are no. But you might just touch a little bit on that.
Okay, well, you've described it well there. There are no fees to get in or get out of the loan note. The loan note will mature. I expect that, let's just say that leak slip one we looked at, probably in the first quarter of next year, that will redeem. And when it does, if it makes up 30% of the loan note, you'll get 30% of the capital back plus your 1% redemption bonus. And along the way, you will have been clipping your 0.5% on that allocation. And you may think at that stage, well, that was nice, Graham, if any more of that, and probably I will. Or you may say, oh, glad to get the capital back. I've something I want to do with it. So that's it. The only fees associated with this are just the fees that you would already have on your portfolio or your pension through SIA managing it. And there are costs, but I've structured those into the note that they're not, that I'm able to pay the 0.5% net of all of those costs.
Okay, there's one now. I'm going to read this one if that's okay. I could summarize.
Yeah.
Apart from the pre-checks by Hayes and Santiago, there's a couple of parts. What kind of ongoing scrutiny of the borrower is performed by the team in terms of credit risk, loan to value changes, and how often do you measure loan to value and credit risk?
Okay.
I suspect that question is getting at ongoing, so a lot of effort and due diligence goes in pre. So as an ongoing.
Yeah. Okay. Well, look, that's perhaps a bullet point that I should have included in the presentation is the monitoring of the loan. We talk to our borrowers very regularly. For all of the loans that are set out to be included in this loan note, they pay their coupon monthly. So it does act as an early warning. If the coupon doesn't come in, Connor Sanfi, our CFO, will be straight on. What's the delay? What's happening? We'll go down and meet them. We'll look at the site. I mean, the value of a site tends not to be that volatile. It does go up when a planning is granted, and for some people that will be when they'll exit the site, exit the transaction. If the coupon is missed, we're all over it, and that's our first indicator. If you take that leak slip site, people looking over the fence at that leak slip site probably for the past 30 or 40 years, and wondering when it would ever be developed. If the borrower got into some kind of distress, or if we see that the borrower, has reneged on another loan or has been taken through the courts, well, we will use the full strengths that the loan documentation give us to remedy the situation. So if we, if a loan, so let's just say the leak slip loan, that the guy stops paying his coupon, and then we see that don't know, there was pyrite in one of his sites or something awful, that he's not got the means he had when we loaned the money. At that stage, we would probably, if it looked like he couldn't remedy it himself, we'd maybe keep the loan going till he got his planning. And when he did, we'd have a collaborative sale rather than pull the blanket from under him all of a sudden. All of our loans are characterized by real estate being a 50% loan to value against marketable real estate. So really, while the wherewithal of the borrower and the ability of the borrower is very, very important, in reality, I take much more comfort from the level of security, because really that's what's going to get you out of trouble if you get into trouble. But suffice to say, the monthly coupon acts as an early warning. Before we take on the loan, we do all our due diligence, and I guess we're relying on the judgment to try and avoid the ones that do get into trouble, but hopefully that addresses the question. Okay, thank you.
There's two questions here, again, slightly related, okay, and I think maybe the second one you may spend a little bit more time on. The first one is, how many underlying loans can be part of a loan note? Now, just hold on to that for 1 second before we come back to that. The second question related to that, what is the maximum loan an investor can invest in? Also, if an investor is looking at a 2 million investment, would it be advisable for him to spread across 2 or more loan notes? Now, I just think, okay, you may just sort of take that in terms of the size. And so this is a loan note which has 6 loans in it.
Yes. Yes. So who came up with the 6? Me. Why? How did I get to 6? I thought, well, I had to look at the portfolio of loans that were available to me to put into it, just to see which ones I felt had good characteristics for investors to be able to understand them and feel comfortable with them. And that they were performing loans, so that was something that was my decision to go with 6. I could have gone with 10. I could have gone with 3. We now know that the Cove loan probably is going to be redeemed before I get to write this loan note, and that one of the other Cork ones, the Cork City one, will also probably not get drawn because we haven't made that loan yet. And what I'd say to that is, well, we have a constant pipeline of borrowings, and that I would pick out a couple of suitable ones and put it to investors that look, that these are the 2 that I'm going to replace those loans with. And that's the thing about the kind of shifting sands. And if somebody wanted to put 2 million in like that loan note has 6 underlying loans, I think that's a suitability question, really. I would be very comfortable putting 2 million into that loan note, because if there's 6 underlying loans, every loan is a 50% LTV or lower. I think.
But yes, but just as the call is recorded, that obviously depends on all of the other due diligence that we do in relation to a particular suitability of a client, etc., etc.
Yeah, that's it. I mean, is it there?
One question I have. So we have a kind of a football team with our 6 good loans on it. One of those gets injured, or in fact, actually, it's quite the opposite. It gets paid off.
Gets bought. He's got to play for Barcelona.
Yes, he gets bought. That's far better. He gets bought and he heads off to Chelsea, a much better team. Now, is what we have on the bench less good, or is that the wrong way to look at that?
I don't think they're less good. If they're less good, I won't be putting them into the loan note. And there's a path worn to our door at the moment from people looking for funding, and the characteristics that I've described in the loans that we've looked at are replicable in the candidates. I see the same terms in the candidates that I'm looking at, and I don't want to make any kind of promises that I may not be able to keep, but I'm confident and comfortable that we wouldn't, like, if people think that this is a good asset class for them and that they'd like to, build up a few 100,000 or whatever target they set themselves and that we deem suitable, we can accommodate it. We'll be able to accommodate it over time.
We have another question coming in from people whichever, but just to relate to that one from myself. So where does Santiago Capital get its inquiries from? Is there a constant supply of inquiries for you and the team to analyze?
Yes. Word of mouth is a lot of it. I mean, this all started with one loan, and not that particular borrower, but a borrower that was introduced to me by that guy is one of our biggest clients. The market, there's a lot of financial advisors in the market that aren't like Santiago Investment Advisors. They'd be guys who are senior in either Bank of Ireland or AIB or one of the other banks that have a little bit of a business advising their clients on financial matters. And they knock on our door all the time and send in. I got talking to a new guy just last week, and he sent in half a dozen proposals, some of which look very interesting. We advertise on Google. I mean, most of the stuff that comes in through Google, we wouldn't want. But you know, you get the occasional good one through that source. I've advertised in the Irish Times. I've written to all of the kind of larger accountancy firms and all of the larger law practices in Ireland, and I've also written to the estate agents. So that was marketing effort that was put in maybe 12 months ago, and we're still maybe somewhat more laterally, but we're still feeling the benefits of that. And what we find as well is that a common characteristic amongst our borrowers is that they're always moving from one transaction to the next transaction. So when they redeem the loan, they have another one that they want you to look at. So that creates flow as well. But there's plenty. And in actual fact, the banks are like, I'm not knocking the banks, okay? Because the banks are working in their own environment and under their own regulation. And I think it must be very tough for them. But the lack or the scant availability of finance, it's just glaring. And there's plenty of people who you'd think would have many choices as to where to go for capital that choose to come to Santiago Capital. And like one thing I hear is just it's so painful to finally get your loan approved in some of the banks that just, you know, the opportunity would be gone. So some of our opportunities are time sensitive. If you think about a site going up for sale, someone buys it, they have a 3-month close, the bank's not coming up with the money. Next of all, they're on 28 days notice. Santiago gets the knock on the door. You might find that there's a purchase coming through from a Clúid or from a Respond, one of these housing agencies, and the promoter has lined up that he's acquiring the site, and then kind of Clúid are taking it on more or less simultaneously, and the housing agency is late by a few months, and Santiago Capital may step into that. So there's a good fertile pipeline of stuff that we can get comfortable with, and yeah, I mean, the more you write, the more you know about, and the more people you hear about you. And we've signage as well. We've a sign on the Long Mile Road that's led to a lot of queries. So hopefully that gives you a feel for it.
Okay. Thank you. Now, Graham, we have a couple of questions, so we might just rattle through these if that's okay. And I'll read them. If a coupon is missed due to short-term liquidity issue of the borrower, but there's a strong value and potential of the project, can the investor expect an accumulated interest on the missed coupon the following month to avoid yield loss? Is this something Santiago team would be looking at?
Yes, yes, it's something we're looking at. Not quite how I describe it, the way it was described there. So let's just say on the poor old leak slip loan, that guy's ears are probably burning now. He's wondering what's going on. It's been talked about. But let's just say he missed his coupon for the last 3 months of the loan, and then he got his planning, and then he sold the site. So that loan would be redeemed. For the investor, they would, the first thing they get paid is their 0.5% per month that they missed for the months missed, and then they would get paid their capital. and then Santiago would get paid its capital, and then that investor would get paid their kind of, I don't want to use the word penalty, but they get an enhanced interest rate for the period that they were delayed. So they would be due an extra 0.25% per month for every month that they didn't get the coupon on time. That's the way that would work. And with the value, if the value holds up and the site sells for over 4 million, there's plenty of scope, and it will be stitched into the terms of the underlying loan that all that has to be paid.
Okay.
So you would catch up.
Thank you. Okay. Are the underlying loans anyway cross-collateralized?
Generally, no. But in the example we looked at, the Cove loan and the Cork City loan were cross-collateralized. But generally, no. So if one goes down, there's no other loan going to make up for it. So each one has to stand on its own merit. Okay.
That is in relation to the loan note, but maybe the questioner is getting at, is a Santiago capital loan, again, let's keep LeakSlip, and apologies, I don't know who LeakSlip, but anyway, does anybody else have a loan out on LeakSlip? I suspect it's possibly what the questioner is getting at.
Okay, so for every loan that we are putting into this loan note, the investors have senior security over it. That if the property gets sold, the first in line is the investor, who's the senior loan holder. And in most cases, the only loan holder, but I guess it's possible that there could be and you know, how do you know that? You know that because you register your interest in the CRO, you register your interest in the land registry, you get, as part of your check for title, you check that there's no other loans in place. And that's all part of the legal process. And that's something that Hayes will confirm to investors, that yes, you have first charge on that property, and that if the property is sold, for the vendor, for the acquirer to take ownership of the property, you have to release it as the senior loan note holder.
I'm kind of very conscious of the time for everybody, and we've everybody still on, which is very good, but we'll just, if there is a default incident, do investors have to wait until the security is realized before they are paid out?
On that portion they would, yeah. On that portion.
Yes, just on that portion of that one particular loan in the loan note, but the rest of it. Okay.
Yeah.
So each loan in and of itself stands as a loan within the loan note, because again, to reiterate, it's not a single loan note. There's 6 underlying loans in it.
Yes, exactly.
Then there's a kind of a point for clarification. There is one hotel, read the other 5 loans, all for social housing, question mark.
Of the 6 I showed you, one is offices on Bridge Street in Cork, the old Victorian quarter, formerly a Bank of Ireland branch, actually, plus a neighbouring couple of properties. But that one we probably won't get to write. LeakSlip will be a mix of housing. There's a good local market for semi-detached and detached houses there, so there'll probably be a portion of the site hived off for social, but it stands up as to the local market. Although I suspect if the developer wanted to fill it with social, he could adjust his planning, and that's an option for him. Cabra, social, Inchicore, social, and who am I forgetting about then? So the one in Cork then is the hotel site with the make weight of the 2 Georgian offices. And I suspect what we see next will probably be social. It's quite a strong theme at the moment. And we like urban neighbourhoods. We like sites that have utility as they are. And we had a site in Walkinstown, which super value sold on, and it had warehousing and some offices on it. And it was actually, and parking, it was a pretty good site anyway. But now it has planning for social housing for 70 units. And there was a frenzy of bidding to get it off the promoter. So it's a thing we like, and you can see why, I hope, from what I've been chatting to you about.
Okay, fine. Is a security held by a trustee for the benefit of the investors?
Yes, it is. Yes. So, and I'm not going to get too I'm not going to answer that question in detail because I'd leave it for the lawyers. But layman's explanation: the security trustee is responsible for making sure that Santiago Capital is doing all that it's meant to be doing, and it'll be hard coded how we behave. So, if a loan goes 90 days into arrears, we've to enforce. There could be a couple of rules like that, and really, like what might an investor be worried about? They might worry that, you know, Graham just decides to go and do something else, and who were Santiago Capital anyway, and gosh, what have I got left? And that's really within the loan documentation, the underlying loan note holders have the power to steer their own ship if they need to, and that's something that the solicitors can explain to them how they will go about that. And I'd imagine if the thing did go wrong and there was dissatisfaction, that the first port of call for the investors, if they weren't getting satisfaction from here, is that they talk to the solicitors, and that security ain't being lifted without the investors' authorization.
Okay, thank you, Graham. So, Graham, you are going to finalise and I appreciate you sort of had went through the fluidity of the underlying loans. You're going to finalise the 6 loans within the loan note, and we obviously have the coupon, and then wearing our Santiago Investment Advisors hat, we will look at this, and where appropriate, we will obviously have our conversations with our clients, and where appropriate, an allocation may be made, or obviously clients can speak to us about the appropriateness within their either pension portfolio or personal portfolio of an allocation to loan notes.
Yes, and I'd encourage people that if they find this appealing and want to put their hand up early to say, yes, that's something that I'd like to look at more closely, say that now. Every loan from conception to being papered and perfected, it always takes a couple of months. So we could allocate 60% of the allocation on the loans that are staying in, with a view to populating the rest as they are ripe for inclusion. And I won't be foisting a loan that somebody doesn't want upon them, so they'll have latitude to reverse out still. But I think I'd be able to give them a good idea of what it's going to be before they get too involved with it. Okay, so with that, I'd like to thank you, Graham. There was my pleasure. My pleasure. I found it very informative. It gave me a new insight into clearly something we hear a lot about, social housing, and it's obviously very, very important development that's going on. So thank you for that, and more importantly, thank everybody. We had a very, very big attendance on the call today, which is great. So thank you to everybody who was on the webinar today, and for all the questions. And if people have further questions, they can obviously email myself or Graham or Nana at our usual email address. So with that, thank you everybody, and thank you, Graham. Pleasure. Thanks everyone.